Steve Liesman is here. He joins us with more on the Fed and Powell's comments that are coming as the central bank embarks on a historic corporate bond purchase program. Steve, we've talked a lot about this, but it is kind of mind-boggling to try and get your arms around what it is they're doing and what they may be willing to do next.
You know, it's a good comment, Becky. I think the Fed's trying to get its arms around what it's doing. And really, we haven't heard from Powell since the end of April. And so we're going to be listening very closely to what he has to say. There's a lot of unanswered questions out there and unfinished business that we'll talk about in just a second. Among the questions for the chairman, what is the status of these $2 trillion of CARES Act programs that Becky was alluding to? What about future policy? A lot of discussion about negative rates, dismissed by a lot of people, dismissed by Powell in the past, but still markets pricing some of that in, and additional quantitative easing. Also, the Fed chairman has really not provided a positive outlook yet as to the results of all of these programs. Looking at the Fed balance sheet, you can see that it's kind of crested a bit. Since the meteoric rise that began in mid-March, where it really rose by $2.4 trillion, it's kind of, just kind of cresting just a bit there. And we'll see if that's because the Fed is about to embark on a lot more work when these programs get going. Here's the unfinished business of the Fed. The Main Street Lending Facility, Municipal Bonds Program, Asset-Backed Facility. Only a part of the corporate bond program is working. My understanding is the Fed is working on these things. We've had bits and pieces of disclosures of what the Fed is going to do. And there's actually some criticism already about whether the Fed is going far enough in its lending to really help the economy. Krishna Guha writing this morning to me in an email exchange, the only borrowers who use the programs will be the ones who are relatively distressed, that is, the weakest of the qualifying group. So the volume of credit dispersed through these programs will be less. He finds Powell following the old Badgett rule of lend at a penalty rate and suggests, you know what, maybe in this environment they ought to go beyond Badgett and make credit more available. So you have some people arguing on one side the Fed's being too aggressive. Here's Krishna Guha and a bunch of others who say, you know what? The Fed needs to be more aggressive, get more money out to the economy, lower the standards so more companies can get help. Becky?
That seems crazy, Steve. I mean, if you lower the standards, all you do is wash out private capital. If everybody can get lower rates and come in through these things, I mean, I think the point and the reason the Badgett rule exists is because you want to make sure that anybody who can get money from the private investors, that they do, right?
Right. But the question is, why does the Fed have to do anything at all? And that's because the private sector is going to be above what's deemed to be a normal rate. Look, this is not science, Becky, and we've seen the Fed set a rate here, for example, LIBOR plus 100 or 200, and then get feedback from the market, and the Fed comes down. Becky, what's been absent, I think, in this whole discussion is really an underlying principle here of who gets saved and why. The PPP program was really, so far, a first-come, first-serve. So you got one salon across the street that managed to get their application in. The other salon on the other side of the street didn't, and this one will survive and the other one won't. We don't know, should these rates being set by the Fed, this is a separate conversation, be set at a place where if you were a good company before the crisis, you should be able to get capital and liquidity from the Federal Reserve? Or should it be set relative to the private sector, which is somewhat higher than it was before and below the private sector?